Our next guest warns the AI-driven rally is getting too extreme. Dan Suzuki is a deputy chief investment officer at Richard Bernstein Advisors. Dan, great to have you with us. You've been a long-time tech bear, long-suffering tech bear.
Sure, it's
harder and harder to make that case, no, with the AI rally.
Listen, I mean, clearly tech has had a big rebound, but I think I've looked at all these historical rebounds that you get after big drawdowns, and it's always a mirror image of what went down, right? So it doesn't tell you anything about what's going to happen going forward. In fact, it's almost a zero correlation with what that future leadership is going to look like. So I wouldn't read too much into it. This is just kind of how things go. And the way I look at it from a macro perspective, this isn't going to be groundbreaking, but it's either going to get worse or it's going to get better.
The economy.
The economy, profits, and if things get worse, I think people are underestimating their cyclicality because what's going to happen? Companies are going to invest less. They're going to lay off workers, have less software licenses. People are going to buy less expensive gadgets, right? But the other scenario is that things get better. And in a scenario where things get better, why would you pay so much for these companies where you're going to have companies that are more cyclical, that are trading at dirt cheap valuations, that are going to see their earnings go up a lot more? So I think in neither scenario, tech has a risk of catching down in a bad scenario or catching or have other things will catch up.
Some would say, though, that in the first scenario where things are heading lower, that this area of tech offers you secular growth, not cyclical growth, that companies need to invest a certain amount in AI, otherwise they are left behind. And that's why so many people are piling in. What do you say? Do you think that's just all hogwash?
I think people jump from narrative to narrative, right? I mean, up until a couple months ago, AI wasn't really on the radar for people. It was all these other reasons that you have to own tech. And so now there's this narrow hope that you got to own AI. But think about what's the difference between AI and internet? Wasn't internet a bigger boom? Yet had you invested in 2000, these were terrible investments. And tech investing overall fell like 17% in that collapse of liquidity and credit during that period. So I'm wildly bullish on technology as an application. I literally, if there's a gadget out there, I probably have it. I love the technology. I think the applications will be huge. That doesn't mean it's a good investment.
So what are you wildly bullish on? I know I'm looking at your notes and it says you're focused on long duration assets, which to me actually kind of sounds like high multiple tech, right? I mean, you're actually playing for growth out in the future. I know that's not what you're saying because you're telling us that that's not your position. So talk about where you really think there are opportunities. It sounds like you think value is your friend and that's the place to chase.
Well, I think getting back to duration, I think, I think the rates are going to go down because I think the economy, it looks like, is slowing down. And I think that's going to bring rates down with it. In that scenario, would you rather own cyclical expensive duration, which is the high growth tech names, or do you want to own counter cyclical cheap duration, which is, I think, what you get when you get long-term treasuries. So I do like duration here, not just duration broadly, but I do like that form of duration. But then what else do we like? I mean, generally, we're in an earnings recession and liquidity is tightening. That's a recipe for owning higher quality assets right now. So we are a little bit more cautious on things. We want to own things that are going to be less sensitive to a slowing cycle. The one area that's different that we've talked about on the show, which is also hasn't been working recently, is China. I think China is the one area of the world where profits are accelerating. I mean, people forget that when the entire global economy went to zero during COVID and things got less bad, that was huge for profits. I think that's kind of where they are today. Not only have they had zero COVID, they had a property crisis and then overregulation of their industries. All those things are going the other direction. I think that's one of the things that's underestimated here.